Right. Good morning, everyone. Just watching the numbers coming in. We've had dozens and dozens of registrations this morning or over the last couple of weeks, and there's a lot of people just registering in. I can see them rolling in from all around the country. So welcome today to learning all about gross profit. What's the magic of gross profit? How does it work? Why is it perhaps the most critical KPI of every business? And also, we want to show you how to raise the your gross profit by 5 to 20%. It's the engine room of your business. It's the financial engine room. It's the money engine room of your business. So gross profit is critical. That's why we want to commit the next 15, 20 minutes to it. At the end of it, there'll be some time for questions and answers. And what I don't answer today, I do see them on the screen. I will record them and I'll get back to you personally with an answer. So, and there's a recording of this, so we'll send out a link at the end of the webinar so you can all take some time and go through it more slowly. So, last year we were the Brainstorm room where advisors and experts and business people came together to help business owners get through the COVID-19 lockdowns. And then we morphed into the Brainstorm Cafe. Now, why did we do that and what's the difference? Well, we still offer the free help desk to help Kiwi owners sort out their business challenges, but now we're focused on short, sharp, to the point, 20-minute webinars every second Tuesday at 10 a.m. So grab your coffee. I'm going to have one while I'm talking if I can. And let's move on. So the first thing is, what's this gross profit webinar all about? What's there on the agenda today? So we're going to talk, what is gross profit? We're going to say, how is gross profit calculated? We're going to say, what are the key ingredients? We're going to figure out, how do you grow your gross profit by 5 to 20%? It might only be 1%, it might be 10%, but I've seen people do 25, 30% after a little bit of planning. So we go 5 to 20% just to be conservative. And at the end of it all, we'll do some questions and hopefully some helpful answers. So let's get on way with it. Now, what is the magic of gross profit? What's the magic of gross profit? It's simply every dollar gained from raising your gross profit flows directly through to your bottom line. Every dollar gained by raising your gross profit flows directly through to the bottom line. Now, that's the magic of it. Now, that's motivation to get on and really understand the gross profit and the probably the lost profit that's hidden inside your business. So, what is gross profit? Gross profit is the money you have left over from your sales after you have paid all the direct costs to make and distribute what you sell. Just think about that. Is the gross profit is the money you have left over from your sales after you have paid all the direct costs to make and distribute what you sell. Also applies to service businesses as well, and we'll cover that. So the direct costs are also known as cost of goods sold or COGS. So those two terms, direct costs or COGS, are interchangeable. Depending on who you talk to, some people talk about COGS, others talk about direct cost. So today we'll cover both, but I like direct cost because I think it's more targeted. Gross profit is the money-making engine room of your business. And most businesses, we only got one engine, so we've really got to make it work for us. So how do you calculate gross profit? It's sales minus your direct costs. Sales minus your direct costs. Calculating sales is the easy bit. The real work needs to go into calculating the direct cost or cost of goods sold. Now, number one, if you're making stuff and selling it, doesn't matter what it is, doesn't matter whether it's a desk like this, a screen like that, or you're making food, all the same. So let's have a look at materials. The cost of raw materials and packaging used to make what you sell. The cost of the raw materials to manufacture, make, and the packaging that goes with it before you sell it. Labor, the cost of labor or contractors to make what you sell. So go back, you've got a sandwich factory. It's all the people in the factory making the stuff. You've got a joinery factory making joinery. That's what happens. And then if you've got a professional consulting firm like we have here, it's all the people down in there working away on your annual accounts, tax returns, proposals, cash flows and budgets. They're my direct costs. And freight, what you pay to get raw materials to your place or to deliver what you sell to your buyers. Freight's important because you've got to get that out, and that's a direct cost. And I know that the people who have registered for this webinar involved in the distribution of what they make, and in the South Island, they're going through all sorts of problems at the moment, getting their product out and getting it delivered because some of our roads are closed and there's a little bit of water lying around. So freight is critical to a lot of businesses. So what about gross profit for service businesses? Well, I've sort of covered that briefly, but let's have a look again. Same formula, but no materials or freight, generally. I mean, most of our product now is delivered electronically or digitally. So you provide a service and then you deliver it without materials or freight. So sales minus direct costs is your gross profit. Now, one thing here, direct costs are wages and salaries paid to the people producing your service. Direct costs are the wages and salaries paid to the people producing your service. And remember, we're talking about service businesses here. So manufacturing and construction, a lot of registrations, and I see all sorts of people here in building, construction, renovation, factories, and so on. So let's keep this really simple as an example. Let's say your product sells for $1,000. The direct cost to make that product, materials, let's say $100, labor, $450, freight, $50, total cost to make that $1,000 is $600. $600. Therefore, the gross profit, that minus that is 400, or 40%. That is 40% of that. Pretty simple, pretty straightforward. And let's have a look at service businesses. Service sold for $1,200. Let's say we've done a tax return for you, $1,200. It's cost us in wages or salaries $900 to do that. We've got $300 margin in there, profit, I should say, gross profit, and the gross profit percentage is 25. So you're starting to see here that when you get to the percentages, you can compare one type of business against another. Apples, pears, oranges, avocados, we can compare the value of that type of business across each other. Note that we always talk about gross profit exclusive of GST. When we're talking about the selling price, it is the selling price before GST. All the other costs are before GST. Keeps it simple and plain, and it is the way it actually appears in your profit and loss account. What is not a direct cost of cost of goods sold? So let's have a look at that. Expenses and overheads are not direct costs generally. So ACC, accounting fees, advertising and marketing, rent, repairs and maintenance, tax, office and management wages, telephone and internet, motor vehicle running costs, and power, unless you are a factory and there's a high consumption of power to make what you sell. So for in this office, we don't put power as a direct cost because it remains the same. Whether we've got 10 people here or 50 people here, the power consumption is pretty much the same. But if you've got a factory and it's making stuff and it's really, really busy, the busier it gets, the power goes up and up and up because you're driving furnaces, machines, and so on. So in certain circumstances, if you've got electricity being consumed or different types of power, LPG, whatever it is, measure that as a direct cost. Now, here's some examples. Here's a retail business. Let's say the product sells for $89 and it cost you $45 to purchase it, to put it on the shelf. Now remember that $89 before GST. And therefore your gross profit is $44. Your gross profit is 49%. Now, in retail, labor cost to advertise and sell a product is not usually a direct cost, as it does not vary when sales go up or down. Generally, if you have a retail situation, your gross profit is the cost of getting that product onto the shelf and the wholesale cost that you had to pay for it. The staff wages don't vary too much. So let's not put them in as a direct cost. Now, here's a different one. Online businesses. Now, I'm just looking at the registrations here. A lot of people are involved in online businesses. So let's have a look at how you calculate your GP. Let's say you've got something and you sold it or you're selling it for $235. The item cost $118 and you're using Amazon. Amazon, say, 15% as a commission to sell your $235 product. Therefore, $35.25 is 15% of that. Freight, courier, and delivery. Now, you've got to get your $235 thingy out to whoever bought it, and you're going to charge, or you're going to absorb $25 of freight to get it there. Now, you've got two options there. You could add it onto there, $235 plus delivery, or you might absorb it. So for this example, we're going to absorb it and say, okay, we're going to build that into the cost price. Therefore, direct total costs $178.25, $235, and out of that 118, 35, 25, 25, 178.25. That's what it's cost you. And in dollar terms, a gross profit, that leaves you $56.75 or 24%. So there's a typical online business. Now, the magic of gross profit percentages. Calculating your gross profit enables you to compare any type of business across all industry types. Calculating a gross profit percentage enables you to compare your business across all industry type and with others in your same industry. So you might have a building company with 20 people and you're building a lot of houses a year, or you might have a smaller building company and you're building 3 or 4 houses a year. You can still compare your gross profit percentage. Theoretically, you can compare your own business gross profit percentage with Peter Becks' Rocket Lab. Now, I'm a bit of a fan of Peter Becks' Rocket Lab because it just does extraordinary things when you think about it. And I've recently read that you'll be able to buy shares. You're going to go public later on this year, I believe it is. So before buying the shares, check out their gross profit percentage. Let's have a little bit of fun here. Let's say they charge $10 million to put your satellite up there to go round and around and have a look at stuff. And it cost them $8 million to do that. So they've made $2 million profit, gross profit. That's 20% gross profit percentage. So in a way, before you buy shares in a company, you can have a look at what their gross profit percentage is and then compare it across all types of investments that you want to make and say, their gross profit's only 9%. I bet their bottom line is going to be very, very skinny. This company over there, their gross profit percentage is 37%. I bet their bottom line is actually going to be quite healthy. So your gross profit percentage is a key performance indicator across all business types. Now, how do you boost your gross profit? So you've heard me waffle on about your gross profit. You've got to get it up. You've got to get it up. How do you do that? One way is to reduce your labor costs. So you pay less or get cheaper employees. That's pretty tough. It's pretty tough in this environment. So, but anyway, this is the theory of it. Or you can increase productivity and efficiency. Now, this is where there is time or opportunity to always increase your productivity and efficiency to make something. Or you can outsource your labor. And if you do that, you save on KiwiSaver, ACC, sick leave, annual leave, bereavement leave, public holidays. And we know that sick leave is going to go from 5 to 10%, 5 days to 10 days. I think that's on the 24th of July. So it's not that far away. And suddenly you've got a liability of an extra 5 days for every staff member. It's a liability, a latent or potential liability. Not everyone will abuse it or use it. But it's there and you have to consider it in your costings. But you might pay more for hours. So when you outsource your labour, the person providing that labour has to do that themselves. So they have to absorb that cost, but you pay more per hour, but you don't have all these other issues. Another way of doing it is to reduce your material costs. So how can we look at that? So you buy more raw materials in larger quantities. Negotiate harder with merchants and suppliers. There's lots of ways to do that, and we'll have a whole webinar on how to negotiate better. or you join an organisation that have group buying power. Builders Co-op, Builder Supplies Co-op. That's a nationwide example of builders coming together, joining an organisation, and being able to buy raw materials to build their houses at the same rate that a large group builder might. But we all know there's a shortage of building materials at the moment, so that's a little bit tricky to negotiate when you're having to pay a premium for a stick of 4x2. That's old talk for anybody who doesn't know. 4x2 is very expensive, especially if it's treated. So we've all got those problems at the moment. And find substitute lower cost materials. So if you're baking something and think, why do I have to rely on that product? Can I find another raw material that will do just as good a job and it's cheaper or lighter, or I'm going to use less of it? So I improve my efficiency and I look for alternative ways to build my product. Or you design a product to use less materials. Now, can you raise your prices? How do you raise your prices without losing customers? Now, we're going to, again, devote a new webinar to this because that's a key question. I want to raise my prices. I need to raise my prices, but I reckon I'll lose business. I reckon my customers will walk away. But research shows that the market is often more accepting of price rises than business owners think they will be. So the biggest sell is often to ourselves. Or as business owners, you think, I'm going to lose my competitive edge. I can't move my prices. I'll have to absorb a higher cost of making stuff. I'm going to have to lower my gross profit percentage. And that, of course, flows through to the bottom line and your net profit starts to shrink. So this whole price thing is a conundrum, but so much research shows that the resistance is often by the business owner, not by the market. So what happens when you raise prices a little and push costs down a little? So here's a little example that we did. Product sells for 100, direct cost is 50, gross profit is 50, gross profit 50%. Pretty simple stuff. Now, let's lower the direct cost. Product sells for 100, lower direct cost to 45. So you chop 45 off how much it costs to make. It was 50, now it's 45. Gross profit now $55 or 55%. You raise your selling price. Product sells now for 110 and it was 100. Direct cost went from 50 to 45. Remember, the gross profit is now $65 and it was 50. That's a big jump. $15 between something that was 65. Now, and the gross profit percentage is 59% and it was 50%. And the gross profit in dollar terms grew from 50 to 65. That's an 18% growth in the gross profit percentage just by doing those little tweaks. So here's an ugly fact. Businesses go broke faster if they have a poor understanding and control of their gross profit. I've seen that over years and years and years. One of the first things I do when I'm sitting down with any business owner, have a look at their gross profit. It's simple stuff, but it tells so much of a story. And here's the beautiful fact, the opposite side of that. Every successful business owner has got their gross profit percentage tattooed into their financial brain. Into their financial brain for every product that they sell. For every day, week, month, or year, they know their gross profit. Continuously, it's tattooed in here, right across the board of all the products that they sell. So after this webinar, here's a little exercise. Extract and write down your gross profit percentage for the last month. Say we're 1st of June today, I want to know it. Or you write it down for May. You could also do it for April, the last quarter, because some businesses are seasonal and your gross profit will go like this. So when you take it in isolation, sometimes it gives you a distorted view. So when you smooth it out over a quarter, it starts to give you the most likely gross profit that you're achieving and over the last year. And if you sell multiple products, extract the profit on your 5 or 10 best sellers. What is your GP on your 5 or 10 best sellers? Because that'll give you a clue. what are all these other ones over here? Why is the gross profit down on those other ones? Maybe I'll get rid of those products or services, and I'll just concentrate on the ones with the biggest margin. And challenge yourself to make these changes. Raise your prices by 1%. Lower labour costs by 1%. Lower material costs by 1%, and make an efficiency gain of 1%. Now, cumulatively, over your whole range, that will have a tremendous impact on your gross profit, dollars, your gross profit percentage, and it all flows through to your bottom line because there's nothing holding it back. It's just sheer gross profit, and it becomes part of your net profit. It's really worth doing. The power of 1%. Now, you may have heard that saying before. It is certainly powerful because it's cumulative, month after month. So, the magic of gross profit, have a look at that. The magic of gross profit is every dollar gain from lifting your gross profit flows directly through to your bottom line. And that's the biggest motivation you could have, because you're going to see results on your bottom line. So that's pretty well the end of the webinar. What I'd like to do is to help you analyze and grow your own gross profit. So if you want me to have a look, send me an email and tell me your gross profit last month, the month before, and maybe the whole of last year, and a brief description of your business. And I'll come back to you one-on-one and say, this is where you sit across the industry. You're a poor performer, you're about average, or hey, you're above average, well done. And here's half a dozen ways in which I think you should look at improving your gross profit percentage. That's all part of what we do at the Brainstorm Cafe. Love doing this stuff. So send me an email. Email address is there, jamie@e3accountants.co.nz. It's all part of what we do. Now, let's just see if we've got any questions coming in. Oliver, can you show me any questions here? Right. One from Gillian here. For professional services, what GP percentage would be considered to be good? It's certainly got to be in the high 40s. The cost of running a professional services company is high, and one of the core costs, of course, is employment of professional people. And if you don't have something into the 40s, I can do some more research on this, but I can certainly give you a detailed answer via email. But I would think somewhere in the 40s, and if you can crack 50, so be it, because the cost of running the business is very, very high. So I think there's quite a few other questions here. What I'll do is, we said it would be 20 minutes, and we're just on 20 minutes now, just over 20 minutes. So if you've got any other questions, send them through to me later, or use that email address there, jamie@e3accountants.co.nz. Send me your questions, and I'll come back with as much detail as I can offer you. So thank you very much. We've got another couple of, we've got 3 or 4 more webinars coming up, and we'll send you all emails so you can log in and register for those webinars. So thanks for joining us. It's been great, and have a great day. And I can see the sunshine is already shining out here for us. Thank you. Bye-bye.